share my screen. Okay, cool. All right, I hope you guys can see that. So the presentation today, I'll just give you a little bit of an overview of what I want to go through. So I'll give you a little bit of background on myself, then go through a few career things, maybe that'll be helpful, and then some personal finance tips, and then get into some stock examples. So the stuff that I really enjoy, and we're gonna just kind of wing it, and I'll ask everybody what are some companies we should look into, and then can share my screen and just go into sort of my research process and how to actually like research companies and ultimately pick stocks. So that will be like the second half of the class. So the first 3 bullet points will be like the first half, maybe the first 30 minutes ish, and then the second half we'll actually go through live examples. So that's an overview. So just my background. Yeah, my name is Ryan Reeves and graduated from Pepperdine 2018. And I just fell in love with the stock market at an early age for some reason, just became a nerd about it. And actually had like a 5th grade teacher who brought in her husband one day after class to talk about stocks. For some reason I stayed, for some reason I found it interesting, and here we are years later. So after school, started an investment research business called Investing City, and the tagline is save time and boost returns. So I'll give like a quick demo. It's basically what I do all day is research different companies and tell people about them, and people pay me a subscription fee. So this is the website, investingcity.org. And here's sort of the, wanted to save time and boost returns, and then have like our actual portfolio on the website, and have a bunch of free education resources, so you can hover over this education tab and have a podcast, blog, and just a bunch of different stuff. So that's a little bit about Investing City. After the stock examples, we'll have a Q&A, so feel free to ask me questions about this. But yeah, that's the website, investingcity.org. If you've never heard about the stock market or don't know anything, a great place to start is this. It's called The Journey, and it just like the idea is to take people from zero to knowing a bunch about the stock market, and you can just read through different lessons on that. So I accidentally stopped my share. Here we go. So that is investing. So that's just like rules of thumb. Obviously, if you live in like San Francisco, that might be higher, and if you live in Missouri, that's probably going to be lower. But that's just like something to keep in mind. And then, all your other expenses, food, utilities, just everything else. And like ideally you want to save as much as possible, but that really is dependent on a lot of things. So this would be like a 12% savings rate, which, if you can target 10 to 20% in savings, like that's very good. If you can do higher, that's amazing. But if you're not saving anything every month, it just puts you in a place where after years and years, you're going to look back and be like, I have no savings, and then you can't actually invest that money, which we'll talk about the second half of this. So this is just, a super simple budget, and, you can, at the end of every month, you can just look back at your expenses and enter them. You can create like another tab here and put your transactions and total it up, and then you can sort of see over time, am I saving money? Am I not? So I hope this is like a somewhat practical tip on just personal finance stuff, and something I do every month. So that's budgeting. So the last piece on personal finance is like retirement and investing. So there's 2 pieces, right? You have saving and then actually investing. So if you save, and you don't have that money really working for you, it's just going to be much more difficult in a long period of time for you to retire. Like, it's very possible. Some people are very risk averse. They just do a great job of saving and they retire. That's awesome. But I think investing, obviously I'm very biased, but I think investing is an amazing way for you to really just build wealth over the long term. And before getting into compound interest calculator, which is always interesting, I want to talk a little bit about a few retirement plans. So you've probably heard the terms like Roth, IRA or 401k, and you're like, what are those? So a 401k is something that if you get a job, your company will offer it. And you might have heard of a 401k match where a company will match like the first 5% that you contribute to your 401k plan. And that's free money. Like that's a very good idea to contribute as much to your 401k as possible because it is free money. So that is definitely important. But a Roth IRA versus an IRA. So a Roth is after-tax dollars. So going back to our budget, it would be after tax we can then contribute that money versus an IRA and a 401k, those are actually pre-tax dollars. So from our original 50 grand, which filtered down into like roughly $4,200 a month, we can actually contribute that amount versus it getting taxed first. The sort of the catch to that is at 59.5, you get taxed on the dollars that you can take out from an IRA and a 401k. That's just, if you take out money before 59.5, you have to pay like a 10% penalty. So they're incentivizing people to sort of save for retirement. They meaning the government. And then Roth is after-tax dollars, so that money can grow tax-free until 59.5, and you don't have to pay any taxes on that money after 59.5. So like a really good, like if your company doesn't offer a 401k, a really great way to save money is opening up Roth IRA, and you can just do that. You can literally Google how to open Roth IRA. There's some great ones like Fidelity or E-Trade, very simple to open, and you can just open that account and it'll give you great tax advantages. And so the contribution limit, meaning like the amount of money you can put in per year, is around $6,000 for a Roth IRA. And if you just put that $6,000, we can actually do that with a compound interest calculator right now. But if you just put that money in over time, it'll be interesting to sort of play with some of the numbers. But let's say you started with $0 in your Roth IRA, $0, and you added that $6,000 every year. So what is that? $500 a month, which I think was exactly the amount of savings we had in our budget. So $500 a month, and let's say you're 20 years old right now, and there's 40 years until you hit 59.5. And like, I know this is a very long time, like why would I think about 4 decades from now? But it's really like the earlier you start, you'll see that the money just grows so much. So it's like vastly correlated to the earlier you start, the more money you'll have later. And interest rates, so that's like the amount of return you can expect in the market. Since like the inception of the stock market, that rate after inflation has been anywhere from like 7 to 9% annualized. So even if we use like a midpoint of that, 8%, in person, it's easy to like just have people shout out like, what do you think the number is going to be? But like just sort of take a second to think like and guess, what do you think this number is going to be? I don't know if there's enough time to put it in the chat or whatever, but just think like, what do you think this number is going to be? And so it's like almost $1.7 million. So even if your income didn't grow over your entire career and you saved like a reasonable amount, you could have 1.7 million tax-free dollars at 60 years old. And it's like, wow, that's actually a pretty reasonable amount. Maybe you can get a 5% return and you're living on, what is that, like 85 grand, which is very reasonable. So you could be like, I did 1.7 times, 5%. That would be like the amount that your money could be growing by. And then you could also live off that. And then the principal, that 1.7 wouldn't be touched. So that's like a very reasonable expectation, and a lot of people retire on less than that. So that's, go ahead. Oh yeah. Sorry, I didn't even see the chat. Yeah, that's it's a really good question, and it takes a lot of like there's definitely a lot of nuance to it because so 401k, it's free money if you can get the match from your employer. So I'm a big fan of, you can just get the match in the 401k. But then I think where it gets interesting is beyond that. I think a lot of people will just say, contribute as much as you possibly can to your 401k. But the problem with that is you never know what the tax rates are going to be 40 years from now. Like maybe tax rates can like rise, maybe they do fall. You just never know what the future is. And with the 401k, you're essentially delaying that tax. Versus the Roth, you know what the tax rates are right now, and you're taking that tax hit up front, but then you're growing your money over time and you never have to pay taxes on that again. The other thing that I think is interesting is especially early in your career, you're going to be making less money likely, and so you can take that tax hit while your tax rate is low, and then in the future, when you're making a lot of money and your tax rate is higher, you won't actually have to pay taxes on any of that money. So that's something with the 401k. Since you're delaying the tax rate, and eventually your tax rate might be way high, and all of a sudden when you hit 59 and a half, you have to take the tax hit versus now when you're not making as much. So it's just there's like something in the industry they call like tax arbitrage. Like you don't really know what your tax rate's going to be in the future, but that's sort of how I think about it. It makes sense probably if you're not making a ton of money to just do the match and then contribute as much as you can to your Roth IRA. And then beyond that, if you have like extra money, hey, maybe you can contribute more money to your 401k, or maybe you can just open up a separate brokerage account that's not actually tax advantaged, but you can actually take that money out before 59 and a half. So there's a bunch of different things you can do, but that's sort of how I think about like the Roth versus the other accounts. Yeah, good question. I mean, people that change a lot of companies, they'll have like five 401ks from different companies and it'll be all over the place. Um, so you can eventually roll them over. So it's called like a rollover process, and it's not like super hard, but it's just like a little bit more technical. You can Google to find out how to do that, but eventually you can like consolidate them. Um, and you'd have to like work with your former employer to do that. But a lot of people just have like a ton of different 401ks that they just keep track of, sort of, which is not like the most elegant user experience, but that's what happens a lot of times. Yeah, good question. Um, so the thing about the 401k is it's employer sponsored. So it's really dependent on the employer, and that was a good question. The last question, kind of like noting that it's really tied to the employer. Versus a Roth or just a simple IRA, it's separate from your company. So you can have that. You switch a bunch of jobs, you still just have the Roth or the IRA. Compounding your money. Maybe you buy. So one thing that I want to just make clear is when talking about it, this is just like a shell for your actual investments. So you can think of it as like a shell around, stocks. Maybe you buy index funds in there, but you actually have to buy investments inside of your Roth or inside of your 401k. In your 401k, the company will say, hey, we sponsor these mutual funds, so you can only buy these, five mutual funds. So the actual number of investments will be much more narrow in the 401k, which is an advantage to another advantage to the Roth. You can buy individual stocks, you can buy index funds, mutual funds, whatever. But yeah, basically, like once you pick one or the other, since it has serious tax implications, you can't like just switch one or the other, but you can have like both at the same time, sort of thing. Yeah, so the fees and stuff have come down so drastically, and it's completely free nowadays. There's one called M1 Finance. Actually, I mean, all of the big brokerage houses like TD Ameritrade, Fidelity, E-Trade, like all the commissions have come down to zero, so you can buy and sell stocks for free, and it doesn't cost you anything to open these accounts. So the downside is, like really nothing. You can buy stuff and start learning about this process. So no, it's completely free. Yeah, those are super good questions. Um, so I mean, when I was younger, I didn't know anything about like the Roth or tax it. So I just opened up a very simple brokerage account, which like you might have heard of Robinhood nowadays, which is just like a very easy user interface to buy and sell companies. So that is a great way to start to like learn about the markets and sort of just like get some skin in the game. So I think that like opening up a Robinhood account wouldn't be a bad idea, just to start learning about things. And obviously there's risk. Anytime you're investing in stocks, there's definitely the risk of losing all your money. But that's why you do research to sort of limit your downside as much as possible. Um, so investing in a recession, I would say that's actually, I mean, this is a super unique time, but I'd say with a few of the numbers. So this is what we had, right? 1.7 million. And if you cut this to 30 years, then you're left with less than half. So you see that the more years that you have money in the markets, there's this phrase that I don't even know where it came from, but it's like time in the markets matters way more than timing the markets. So really, just the amount of time you can spend investing your money really helps. I mean, by the time you're 70, remember 40 was, this is like saying somebody's 20 years old. So 40 was 60 years old, and 50 ends up in $3.7 million, and that's still like normal market rate of return. If you can maybe beat the market slightly by choosing your own companies. So this is only 2 percentage points, right? But it goes from 3.7 to 7.7. Just 2 percentage points can really make a huge difference, and so that's why I'm a big advocate of like learning about the stock market and learning about investing in really good businesses. Because while it's very difficult to do, it is possible to slightly beat the market. And I mean, even if you're 60 and you had almost $3 million, like it'd be fine. It would empower you to be able to give to whatever you wanted to just not have the like the stress about money. And I think that money, it's just a thing. It's really ultimately about like the freedom and everything that comes with that, and being able to be generous and a lot of good stuff like that. But I just want to play around with a few of the numbers of the compound interest calculator. I can put this in the chat as well because I think it's pretty interesting to just play around with some of those numbers and just see, like just different scenarios. But yeah, that's pretty much the main first section of this presentation. I want to go quickly through a checklist that I like to go through, and then I want to pitch it to you guys on any companies that you're interested in, and then we'll go from there and go through sort of my research process. So while I'm going through this, be thinking about a company that you're interested in, and not sure how we want to do this. Maybe we'll just put it in the chat, and then if we, is there like a polling function or something? And maybe we can just get like a couple in the chat and then we can poll on it. So this is my investment checklist. And the first question is, am I interested in learning more about the company? If I'm not interested in the company, my feeling is I won't do the necessary like digging of finding different aspects of the business model or competition, and then I won't have an edge against other people in the market. So I'm really curious about finding companies I'm really interested in learning about. And then I'm not going to go through all of this, but I just sort of want to give you an idea of this checklist because just to like break up the broad categories that we're going to go through when looking at these companies. So a circle of competence is an important concept, and it's basically what are the sort of business models that I understand really well. Like you've been to the grocery store a lot. You could probably understand that the grocery store buys products from distributors and then marks them up a little bit and then makes a margin on that. And there's different categories where they make more margin and other categories where they make less margin. You probably know how Netflix's business model works, however much you pay per month, and then they have to pay for bandwidth and servers to actually upload content. So there's just like a bunch of different, like I know really not that much about oil and gas. Like I don't even know how the process of oil is refined and distributed to gas stations, and it's way over my head. So that would be like outside of my circle of competence. And then the concept of a moat is really interesting. It's another term for it is competitive advantage. So why is one company essentially better than the other, and what makes it hard to compete with this company? Like an example of a great moat is Amazon. If you think of, hey, we're going to pool all of our money together and compete against Amazon, that would be incredibly difficult. They've spent tens of billions of dollars over the last 20 years investing in crazy infrastructure, logistics, fulfillment, warehouses. They have, over 100 million Prime members. It's just very difficult for us or any other company to really compete with them because they have such vast scale. So that would be like a type of moat. And then going into the management team, is the company culture interesting? Do they seem like they're innovative? Things like that. And then the financials are a really important piece. How much is the company growing? Is it very profitable? Is it not profitable? Do they have debt? Just a bunch of different things like that, which will really enable you to sort of limit your downside on a company. Because if the company has a ton of cash, like Microsoft has a ton of cash, not really that much debt, very profitable, it's just very difficult for this company to go bankrupt because they have so much in reserves. So there's like a very, very minimal chance that you would lose all your money on an investment like Microsoft versus a very cyclical company that doesn't really have much cash at all. Then your probability of going bankrupt is much higher than say like a Microsoft or something. And then an interesting piece of investing is our biases. So we don't have to go into this a ton, but there's a lot of things that our mind tricks us on. Like for instance, if I've spent a ton of time researching a stock, I might feel like I should want to buy it because I've wasted all this time if I don't buy it. But there's this thing called the sunk cost fallacy, where all of that time has already been spent. The only decision I can make is looking forward and deciding what's the best decision for the future. Like the time that I already spent it's already been spent. I can't get that back. So you can't let that sort of color your judgment about the future. So that'd be like an example of a bias. And then evaluation, like what are people paying for this company, and do I think that that's too high or too low? And there's a bunch of different thoughts about how to go through a valuation process, but that's something that's important. If you pay just like way too much for a company, that sort of means that your returns will be much lower. And so there's a lot of nuance to that, so I won't get into it too much, but those are just sort of some things that I look at when going through a company. So let's get some feedback from you guys. What companies are you interested in? What companies are you seeing around? And maybe it's not public, and so we can't we can't look at that one, but I would love to just hear about some companies from you guys. Nice. Love it. I bought Apple at the split. Nice, Dante. Okay, super good. On these, but oh, sweet. Okay, let's do Zoom, Facebook, Chipotle, and Target. Sure. Sure. Let me find it. Giving away my secret stuff. Oh, cool. Okay, perfect. Let's just do both of them. We'll start with Zoom and then we'll go to Target. Okay, great. So this is sort of funny, but we're using Zoom, and Zoom is actually, like, I sort of got very fortunate with this company because I've owned it since pretty much like after the IPO, and it's grown into like one of the biggest positions in my portfolio. So it's like a company I know very well. So it's kind of interesting that we picked that one. Okay, great. So let me bring up my notes. It really is like a hub for every piece of information that they put out. So on our checklist, are we interested in Zoom? We've said a resounding yes. Is it in our circle of competence? Do we know how Zoom makes money? So, I mean, even understanding, like, let's go to, I think it's actually not even .com, it's .us. Like their website, I know Zoom gave a bunch of free licenses to K through 12, but it would be like interesting to know how much is Pepperdine paying Zoom, and like how did they make that decision? Why did they use Zoom versus Google Classroom, or just like understanding all of these little things that really culminate in understanding Zoom as an investment. So this is their price. So it's not a huge cost, $12 per month for a small business. It's really not that much, and you're getting to interact with your employees. So it's very low cost versus a very high value proposition. And the thing about this time period is it's completely unprecedented. Like Zoom literally sat in a perfect storm. I mean, just all the video conferencing that's going on. I mean, even this, it's really crazy. So we know what Zoom does. Okay, it's in our circle of competence. We can head over here to the investor relations page. So while I'm going through this, I would be interested if you guys put some suggestions in the chat of like, what do you think that Zoom's competitive advantage is? Like, why do people use Zoom versus another video conferencing app? So start putting those in the chat, and while I go through this. So this is the investor relations page, and you can see that Zoom's down a bit today. But these are all these tabs, right? And if you go to press releases, that will show a bunch of the latest news on the company. And then 4 times a year, the company reports earnings. And these are really important because it shows us how much the company is making in sales and profit, and that really drives the long-term value of a company. Essentially, the value of a company is pretty much directly tied to how much it can earn over time. So a company that is growing its earnings very quickly, it will be a more valuable company. And if we see this, the second quarter revenue is up 355%, which is an insane amount. Like, it is the fastest growing company out there. Like, it's pretty, the fastest growing, like, legit company. I mean, in 1 quarter, it essentially doubled its entire revenue base. Like, so since Zoom is a company that I follow pretty closely, I can actually pull up the financials and we can go through that and see a little bit of the trends of the company. So let me just pull this up real quick. So this is something that Investing City members have access to, and so these are the revenue numbers for Zoom. So every quarter, they report their revenue, and so this is what it is. And you can see that in just 3 years, so 1, 2, 3, the company has grown its revenues by 20x, which is just, it's insane. So we can see the actual year-over-year growth numbers, and you can see it was sort of decelerating. So this is a little bit before IPO. It was sort of decelerating every quarter. The growth rate was decelerating, and then COVID happened, and you can see just like how crazy of an impact that was. So it's definitely benefited a ton. I mean, you can see that the company earned $18 million in earnings over the past 2 years, and last quarter it did 10x the sum of that. So it's like a crazy, I really can't get over how perfect of a storm Zoom sort of fell into. I mean, I've never seen numbers like 355%. Okay, so I'm going to look at some of the suggestions. Okay. Name brand recognition, definitely. Very easy to work with. Brand recognition can be used globally. They were the first company. Free has classroom-specific features. Focus on the business sector. Best for class. Breakout rooms. Good group functions. Okay, awesome. So it's pretty interesting because Zoom, I mean, there was a bunch of different video conferencing apps before them. Like Skype was definitely the biggest one. I think it was really like a verb even before Zoom was a verb. And it's an interesting story about Zoom's founder, actually. It's this guy named Eric Yuan, and his visa, he was from China, his visa was denied 8 times to get into the US. He finally got in, and he started working for this small company called WebEx. And WebEx is a Zoom competitor now. They were actually bought by Cisco, and Eric left WebEx because he thought the product just wasn't as good as he thought he could make it. So he left, and like 40 engineers, software engineers from WebEx, who are now under Cisco, they left and followed Eric to start Zoom. He's a really amazing leader. But yeah, they definitely weren't the first, which is like a pretty crazy sort of thing, but they definitely have the name brand recognition now. And what's really interesting about Zoom is that a lot of people would say that they probably don't have a moat. Because, it's just a video conferencing app. What is stopping another, why is Microsoft, who owns Skype, why, are they not succeeding? Why is Google Classroom not doing as well? Because they're very focused on the education sector. So there's a bunch of different reasons why it seems like Zoom doesn't have a moat. But I mean, you really can't deny these numbers. Like, at the end of the day, a moat is sort of an abstraction of a company. So, I mean, you can say that Zoom doesn't have a moat, But I think one comment that really got to the heart of it is that it's super easy to use. And that's not necessarily a mode, like somebody can copy that user interface, but it's really just like a perfect timing of Zoom was starting to become the leader. They had this great user interface, and then this worldwide pandemic happens, and then it jumps to become a household name. And all of a sudden, once you're a household name, your customer acquisition cost is much lower than competitors. And then since you have lower costs, you can invest more money into the product, and then a better product means more users. And it's sort of this cycle that Zoom, I believe, has been in. And so that's like an example of sometimes you have like this idea of, okay, Zoom has to fit in this perfect box of a moat. And who knows, maybe in 5 years we'll look back and say like, wow, Zoom really didn't have a moat and it was completely taken over. It's definitely a risk, so it's something to sort of keep in mind. So yeah, I mean these are the financials. The things that I really try to look at are revenue. So EBIT is earnings before interest and taxes. It's a proxy for how much the company is earning. And then another thing I like to look at is free cash flow. So it's like actually how much cash is going right into Zoom's bank account. And this is sort of the number, which is, it's crazy. I mean, last year it earned 114 million in free cash flow. In the first half of this year, it's already earned 5x that number. So I'm just getting at the point like Zoom is doing very well financially. So another thing that I want you guys to maybe put in the chat is something else that you're interested in about Zoom, something else that you'd like me to look at, and we can sort of go from there. But in the meantime, I'll go through more of the investment checklist. Oh, cool. Perfect. Yeah, good question. So I mean, just the growth really stood out to me. I heard all of these people saying Zoom doesn't have a moat. They're going to get taken over by Microsoft. Like there's nothing special about this company. But I mean, it was growing even before the pandemic, 70, 80, 90%. And the more companies that you look at, the more context you have. So I knew that was a very like top decile growth rate for all companies out there. So whenever I see something like that, it sort of piques my interest. And then a lot of companies that are growing this fast are losing a lot of money because they're investing a lot of their excess earnings back into the business. And we saw that Zoom was still earning a lot of, like, not a lot of money, but it was like around break-even point. I mean, there was some negative quarters, some positive quarters, but to me that was really impressive because they were still growing a ton. And like I said, the value of a company is really how much it can grow its earnings. And if you look at this, the company doubled its earnings, which is not an easy feat. And this year it will, 10x, maybe 20x its earnings. It probably way more, honestly. So that really piqued my interest, and then I did a ton of research on the competition, like understanding where it was relative to Cisco's WebEx and Microsoft Teams, which is a big competitor in the business sector. And Zoom, just the product reviews that they got, like time and time again, it just works. It just works. It just works. And so I sort of dug into like why is that? And turns out Zoom was built for the cloud. So you can actually enter a Zoom conversation without having the app downloaded, which is a pretty novel thing to start out. Now the competitors have sort of copied that, but it was built from the ground up for the cloud. So one technological advantage of that is if you use Cisco or a competing product, you will be routed to the data center closest to the host. So your professor's the host. All of your feeds will essentially, the bandwidth will be run to the data center closest to her. versus Zoom like rebuilt the architecture where they have globally distributed data centers, and all of our streams go to the data center closest to us. So that's why the bandwidth is like so much better. And there's different like technology sort of advancements that are under the surface that made Zoom what it is. And not to say those aren't replicatable, but it's just sort of things like that that you find out over time. But the thing that really attracted me initially was like, this is an amazing earnings growth, and for it to be growing this fast and actually still making money was really interesting. Yeah, I mean that's a really good question because it's something I've been thinking about a lot. I mean, if it comes out with the vaccine tomorrow, there's a very likely chance that Zoom stock will fall a lot. It just seems like the natural thing that would happen. Um, so one thing on that is the company has forecasted that next quarter and in quarter four that they will already grow about 300%. So that is money that they feel very confident that they will have in terms of revenue. So while it's not guaranteed, companies that put out their guidance, they're typically very certain that they can at least reach that minimum threshold. So I think next quarter it will be well above 314%, and even if the problem is next year there's no way that they can really like continue to grow 100% on top of these crazy numbers. There's just no way. So in the coming years, it will look pretty funky. Like I think that there's, just growth won't look nearly the same. But I think if you look out long term, video conferencing is a $40 billion market. Zoom's only done $2 billion in revenue. So less than like 5% penetrated into its entire market. I think there's definitely a lot of different use cases for Zoom. I mean, who knows what changes? Like, I think telehealth will be a really interesting application from here on out. Maybe telehealth will just become much more of a normal thing. So there's definitely things that I think the pandemic has really changed for good. But to your point, I think there's things that definitely won't change, and then Zoom will go back to being. I mean, even before the pandemic, it was growing very solid rates. So I don't think that Zoom will just be like a terrible company after the pandemic. I think it's certainly helped, and then I think maybe the positive is now it has all of these customers, and maybe they don't go. I think like the work from home thing is definitely like a lot of companies will adopt that, and some will go into a hybrid model, some will go completely back to work. So there's definitely just like the natural, like some companies will stop using Zoom. That is how it's going to happen. Um, so I don't think it's necessarily too late, but you just got to be like prepared for the volatility that comes. We have no idea how long the stay-at-home sort of quarantine stuff is going to last. But I try to just tune that out as much as possible and really focus on like where do I think Zoom could be in 5 years, and I still do think that it could be a bigger company. But especially since the stock has run up, it's a harder bet to make. But yeah, we'll definitely see some slowdown if the vaccine comes out tomorrow. But at the same time, I think that it still has a lot of runway for growth. Okay, we're good on the questions. Yeah, super good questions. Okay. So yeah, I mean that's really the idea. Like understanding how its earnings are growing, understanding the business versus competitors, and all that sort of stuff. So yeah, let's move on to Target, and that could be a really interesting one because I've never really looked at Target, and it could be interesting to get some of you guys' feedback on this company. So let's go to Target. So there's this website that I like to look at called stockrow.com, and it provides a snapshot of the financials of hundreds and hundreds of companies. So if I've never looked at a company before, I'll try to pull up the Stockrow page of it, and it gives you just a quick snapshot so you don't have to go through all of the quarterly earnings reports for every company. So this is Stockrow. So it's just stockrow.com, and we can type in Target. So that's the ticker right there, TGT. And then it'll pull up this page. So Target, I think, has done super well. Yeah, I mean, that's the stock chart. I try to not look at the stock chart too much because I think that plays into your bias. Like, oh, it's gone up so much, it can never keep going. Versus if you look at the financials and the actual business, maybe there is some more potential. So these are the quarterly growth rates. I mean, you can see that it's got a big tailwind from the pandemic. 24%, last quarter was 11%, and then only 2%. So you can see that revenue is accelerating a lot. So that's interesting. Like, obviously it's because of the pandemic, but you can see also that earnings right here have pretty much doubled in 2 quarters, which is also pretty crazy. So it makes a lot of sense that Target is doing really well just because of it's open because it sells groceries, and it's I believe it's done very well in like online ordering, but a good place to go is just the last quarterly earnings report so we can just get some more context on the company. So we head to their investor relations page. I mean, obviously Target has a great brand, but I think they've really done a good job of investing in online. So yeah, there we go. Okay, here we go. 4 percentage points of Target's comparable sales growth, which is crazy. So this is second quarter comparable sales, so 24.3%. So they're saying that digital accounted for about half of that 24%, right? 13.4 out of 24.3. So digital has become a huge line item for them, which is pretty surprising. I mean, I didn't know that Target is doing so well in really investing in online. So that would be something to really look into. And so maybe you read a couple articles on this and you have a little bit more context. So here we go. Amazon's rivals Walmart and Target gain ground. So that's pretty interesting. And then so like I don't want to just read these on the screen because that might just be boring, but just sort of asking questions and then going out and finding the answers. That's a lot of just what investing is. So, why are they growing sales so fast? Obviously the pandemic, but, Amazon's not growing digital at 195%. So then you understand like, oh, actually digital is only whatever percent of Target's business. It's only 10%. So it's a much smaller number to grow off of. So you can kind of understand the differences. So one area of valuation, so like how much is this company worth? It's something called let's see. It's something called the market cap. Here we go. So the market cap is the stock price multiplied by the number of shares outstanding in the company. So the stock price is 153, and the market cap was 75 billion. So 75 billion divided by 153. I mean, that's not billion, but it's just easier to look at. So they have roughly like 490 million shares outstanding, and that's how you get the market cap. So if you wanted to buy Target, you would have to put up at least $75 billion. So that's sort of like, so way bigger than Target. And so it feels like the market has definitely figured out that, okay, obviously Amazon does all of their business online, and that so it's probably likely that Target only does a small piece of its business online, which is pretty crazy. I mean, Target is, I don't know the math on that, but that's like 5% of the size of Amazon, which is pretty crazy. How big Amazon is. So, any questions on Target so far? Yeah. So I guess what makes all of this pretty difficult during the pandemic is we really just don't know timelines of things, and so I mean, obviously they've gotten a huge bump from COVID. I think that that's pretty clear. I mean, there's no way that I think that digital would have grown 195%. So one way to get an idea of that is to go look at earnings before COVID. So that was in August. If we go to some earnings calls, we can see if they break out how fast digital was growing. So we remember 195% in August. So that's May. We can check that out just for reference. But it would also be interesting to look at even before COVID um, really was blowing up. Let's see what Target did. So this is March. They probably wouldn't have got like a huge impact yet. It was early March, like late February. So that could be a good place to start. So here we go. Before the pandemic, digital sales grew at 20%. So we see like, wow, COVID really impacted their digital sales. And so that's good context. And this is digital. Okay, so before the pandemic, 20%. In May, sort of during the pandemic, like kind of the height of it, 141%. And then last quarter, where they had a full quarter impact of the pandemic, 195%. So that really tells us, wow, they're getting a huge tailwind in digital from the pandemic. So that's just something to keep in mind. Like that also shows us it probably wasn't coming to them if this hadn't happened. Versus like Zoom was already growing 80%, versus they were growing like digital maybe 20%. It's obviously Target does much more revenue than Zoom, like way more. So it's hard to sort of pick and choose like that. But that's definitely an interesting element. Which is, it's pretty crazy. Look at this. Digital sales accelerated every month from 33% in February to 282% in April. Like, that's pretty insane just how fast things moved online to e-commerce. On Twitter, I actually posted this chart that showed like 10 years of e-commerce penetration. It went from, I think it was like 5% in 2009. Like 5% of total retail was e-commerce. And then in the decade, we got from 5 to 15% in like 2019. So in 10 years, it took, like in a decade, we went 10% more in terms of e-commerce penetration. And then during the pandemic, in like 6 months, it went from 15 to 25%. And so like that amount of e-commerce penetration in 1 decade was equaled in 6 months. Like it's just unprecedented sort of macro changes. And so when you were thinking about at the beginning of e-commerce, like I mean at the beginning of the pandemic, like whoa, there's some serious tailwinds of e-commerce. And so there's a bunch of companies that have really benefited from that. The problem is with these sort of shorter term, I mean, you just never knew. Like, you never knew the timeline of the pandemic, and it was just super hard to tell. And there's like people talking about COVID plays, like, oh, I'm gonna look in telehealth and Zoom and all of this. I think that that's inherently like a very short term view, and so I prefer to like just tune out the noise. But there's definitely inherent value of like being able to think through these things and like, oh, it's obviously e-commerce is going to get a tailwind. How do I profit off of that? But it's also weird to like talk about it like that because COVID has been so terrible for so many people. So it's really tough. But I prefer to look at like 5 years. Hopefully the pandemic is long gone, and what are the businesses that are going to keep doing very well. So it's hard to like get too short term of, oh, Target's going to report a great quarter because of COVID, and really just focus on like, what do I think is a great business, and try to ignore the noise as much as possible. But it's pretty clear that the Target has definitely got a bump. One thing I want to point out is some of the differences. So gross margin is a really interesting data point. So gross margin is your revenue, and then you subtract out your cost of revenue. So if you are Amazon, you think about the way that Amazon works. They have big warehouses, and they buy. So there's two ways that Amazon makes money on its e-commerce business. It is a first-party provider and a third-party provider. So first-party is they actually like take on inventory of the goods. So let's say we make a product and we can sell it to Amazon, and then Amazon lists it on their e-commerce site, and then they sell it. So Amazon actually takes hold of our inventory. Versus third party, we essentially like plug in our product to Amazon's e-commerce site, and Amazon just acts as a marketplace. So since Amazon doesn't take on the inventory, the gross margin is much higher, because if you think about it, the only thing that they're really providing is internet infrastructure versus them having to actually like pay for our product and then mark it up. So from Amazon to Target. And then we can look at other different grocery stores like Costco, or just get like a context of what are really the margins of this business. So this is gross margin. So Target is like 30% gross margins. So they don't make as much per dollar of sales as Amazon, at least on a gross profit basis. So that's something to keep in mind. And if we look at Costco, which Costco is a really interesting business model, their gross margins are only 13%. So Target actually has double the gross margins, almost 3 times the gross margins of Costco. So what that means is if you buy peanut butter from Costco versus peanut butter from Target, Target's margin on that, on like the actual peanut butter that they buy and then mark up and then sell, Target's margin is much higher. So that shows you like, oh, that's why I get so much savings when I go to Costco. So you can see that directly in the financials between like a Target or Costco. I think Walmart's gross margin is something like 25%. So you can see how much lower Costco is. And then the reason Amazon's is higher is because they have that third-party piece of their business where all they're doing is just listing other products. And then they also have a cloud services business that not a ton of people outside of like tech and stuff really know about, but they provide like the internet infrastructure for like 40% of, it's just crazy how big their internet business is. but that's why their gross margin is a little bit higher. So now we have like some context. Okay, Costco is really low, and they don't really they compete on price a lot. And then Target's similar to Walmart. And why can they charge a little bit of a higher price than Walmart? So we can start asking these questions and figuring out the answers. So that's how I would sort of go through this process of figuring out. But we can see that the margins, like the actual earnings on Costco, are like 3%, which is pretty crazy. I mean, for every, let's say you go to Costco and spend $100, that means that they in profit on that would be like $3. And it's actually pretty crazy. If you look at Costco, they essentially break even on all of their groceries, and then the $60 annual membership is pretty much that 3% profit, which is a pretty crazy business model. But it's just much different than Target or Walmart. Costco just keeps the markup super low. So we can see that Target's margin is, anywhere in the realm of 5 to 6%. So that's double the margin of Costco. So that would be something that's pretty interesting, figuring out why do people pay more when they go to Target than Costco. And there's all sorts of different reasons. There's convenience, there's just more targets. But that would be like sort of the questions that I would start asking. Does anyone else have something that they want me to go over on Target? What does it look like versus competitors? If you see Costco's margins way lower, and maybe Costco's done super well, you might ask, like, maybe I'll actually start looking at Costco and figuring out that company. And so it's just this never-ending process of being curious about different businesses. And then the more you look at, the more context you have. And so you're able to understand the ecosystem and understand different pros and cons of each different business model. But that's really where I spent a lot of my time figuring out and understanding, because if you don't really understand the business model, you can't really understand how the company grows. I mean, if you just think about Target, the way that they actually make money is they can make more stores, they can increase the revenue per store, or they can raise their prices in the store, which will directly translate to the latter. So you really have like the revenue per store and the number of stores, which really drives the revenue, which then if they can be more efficient with that revenue, they will have higher earnings. So you can kind of break it down every business and understand, like, through each piece, can I understand how much earnings will grow in the future? And then you can understand, like, is it reasonable? Do I think they can grow at this amount in 5 years? And if I pay this for the stock, then I can like project this sort of return. So that's really just like at the end of the day what investing is: understanding the business, understanding what it could do in the future, and then seeing how the value plays into that today. And if you can do that for a lot of different businesses over time, going back to that compound interest calculator, it really you can grow your money and really just the long game. Like I said at the beginning, you can really have a big impact, and that's why I'm so passionate about this. But that's pretty much all I have for today. If you have any questions, feel free to put them in the chat. But thanks so much for listening. Oh, I hope so. Yeah, it's pretty nice. Thanks so much, guys. Appreciate the comments. So I want to mention one thing before I log off. I'm going to go back to my presentation here. So we have a newsletter that is like, it's called Business Breakdowns. So twice a month, We just break down a business exactly like we're doing, but in written form. And we have a student discount, so if you're interested, it's just businessbreakdowns.substack.com, and student. So I think it comes out to like $2 a month. Try to make it super reasonable. And yeah, if you want the link or whatever, I can put it in the chat. But or if you just want to reach out, like last year we took on some interns from Pepperdine graduate school. So if you're like super interested in finance and investing, feel free to email me. We can reconnect maybe next year or maybe even this year. Who knows? But that's my email, ryan@investingcity.org. And then I'll put this discount code definitely. So I just wanted to throw that out there as well.